Definitely not for everyone, but I've got a unique tax strategy for those of you with high income. That and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. There's 6 areas to your financial life and my financial life. Everyone's financial life is made up of these 6 areas. And the big idea is looking at how those different areas work together so then you can make decisions, great financial decisions that bring synergy to those areas. And when you do that, your CFP should be doing that for you. You're able to uncover opportunities. And here's a unique one. It's a unique strategy, does not work for everyone. But if you were to say, well, which of these 6 areas does it land in? Mostly tax planning, okay? Mostly tax planning. There's a difference between tax planning and tax preparation. Tax planning is proactively looking at opportunities for you to pay the least amount of tax over your lifetime. Sometimes that means doing a Roth conversion, paying a little more tax today, but avoiding tax out there in the future. Tax preparation is reactive, right? Planning is proactive. Tax preparation is, looking at last year, getting the right number in the right box and truing up your tax picture. So tax planning, but here's why I'm starting before I tell you the strategy. I'm saying that this has to fit within all 6 areas of your financial life, because if it's just about tax planning, then you're missing it, because it also impacts your cash flow and how much cash you have on hand, your present financial position. That's another area of your financial life. It impacts your investment planning, you're gonna see here in a moment. Impacts your estate planning, your legacy planning as well. So this strategy is not for everyone. I'll tell you the conditions here in a minute, but it truly emphasizes that you need to be taking a comprehensive look at your finances and looking at all 6 areas. All right, so what are the criteria where you might consider a strategy like this? Number one, you're gonna have high income, and what I mean by that isn't above a certain level, but just relatively high, meaning you've got disposable income. After saving up into your retirement accounts, you still have excess that you want to save and that you can save. That's one. Typically, high income means the second criteria, high tax bracket. You're actively looking to how can I pay less taxes in these high tax brackets. So not in the 10 and 12% tax bracket, and likely not even in the 22. You're in the 24 and beyond tax bracket, actively looking for ways to reduce your tax picture today because you're in a high tax bracket today, hoping to be in a low tax bracket out there in the future. This disposable income means that not only have you contributed the maximum amount to your tax shelters, but you've also been saving into a non-IRA account as well. And some people do this because they want to open a Robinhood account or they want some play money. Now, fund your Roth fully. Max out your 401k. But then beyond that, if you still have disposable income and you're still saving up for your future, then saving up into a non-IRA account, that's another qualification before I would tell you this strategy applies to you. And then lastly, last criteria that would make this strategy appealing is you've got all of those factors, but then you also are wanting to donate to charities. There's maybe a charity, either the church or other organizations, nonprofit organizations, that you want to bless with your resources. If those criteria apply in your situation, this tax strategy could make a lot of sense for you. So what is it? It's active tax loss harvesting, funding a donor advised fund, and then using your cash flow to buy up your cost basis. And there's a lot of jargon there, so I'm gonna break it down, but that's the strategy in an essence. All right, so here's what that means. In your non-IRA, your non-retirement account, your investment strategy you would structure where it's more aggressive and where there's some opportunities for you to look at the individual components of your diversified long-term portfolio. It's likely in stocks because, again, growth oriented, but there are times, stocks or exchange traded funds, but at times when a investment has temporarily gone down in value, you have the opportunity and you capture the opportunity of selling that investment and not buying it back for at least 30 days so that you're capturing actively tax loss harvesting opportunities. So what this could look like is you own a basket of individual stocks or a basket of exchange traded funds, and you have a system where you are hopefully working with a certified financial planner like us or something like that, where you're looking at those investments every single day. You're not trading every day, but you're looking every single day to say, okay, I like each of these investments. These are ones that I want to hold for the long term, but has one of them gone down in value recently because it's, for whatever reason, short term out of favor, and I could sell it and capture a loss. And when you're actively spotting those opportunities, you then can't buy that investment that you want to hold. You can't buy it back for at least 30 days. And so you use those proceeds to invest in something similar to that. Not the same, but something similar to that. So you're still getting the same sort of potential investment experience for those 30 days, but you've been able to capture this loss. There are active strategies that do this, and you're able to see, even though in a portfolio where over, say, a year, your positive performance, you've been able to actively capture a decent amount of capital losses that will land on your tax return. Those active losses then land as capital losses on your Schedule D. They are able to offset any capital gains that you might have from mutual funds or from other tax gain harvesting. But then you're able to deduct up to $3,000 a year, and any capital losses that you're carrying that you have above $3,000 a year carry forward and can be used in future years. But here's the thing. Now what that means is you've got a portfolio of investments in this non-IRA account that has done well, but in pockets where there's been some opportunity to capture losses, you've been capturing those losses. So what does that mean? You now have a portfolio of investments that has a lot of appreciation that whenever you sell it is going to be taxable to you. So you might on the surface say, well, why would I do this? Capturing a loss today means I'm going to pay more capital gain out there in the future. This is nonsense. It's not. Because then that goes to some of the other criteria. Then once a year or maybe once a quarter, depending on your situation, take a chunk of those highly appreciated investments, the ones where now they've run up in value, and instead of selling them, and also instead of using your own cash and cash flow to donate to the church or donate to the charity you care about, transfer or gift or donate a chunk of these highly appreciated stocks or investments to a donor advised fund or directly to the church, to a charity, and you get a deduction, you get a tax write-off for the market value of what you sold or what you donated, what you gifted. So say you want to donate 10 grand a year to the church. Find $10,000 worth of securities, worth of investment. Even if your cost basis was only $4,000, it's now worth $10,000. Donate that $10,000 to your donor advised fund. That gets you a write-off, a deduction on your taxes, a charitable deduction for that full 10 grand, even though what you only paid was $4,000, if that's the cost basis. And then because you donated an investment to the church or to the donor advised fund, your cash that you otherwise would have donated to church, you can then put into that your non-retirement investment account and buy that same investment back, and you don't have to wait the 30 days. So say, for example, you've got an S&P 500 index fund, we'll keep it simple, that within this non-IRA account, and you've been capturing some losses on your emerging markets fund and your small cap funds as those have been more volatile. And so you've been capturing some tax loss, but your S&P 500 index in your non-IRA hasn't been an opportunity to capture any losses. It's just been doing great. And now your $4,000 that you put in there is now worth 10 grand. Okay, you've been selling those other investments, capturing losses, reinvesting in something similar, but it comes time for you to make your annual or maybe your quarterly donation to the church or your donor advised fund. You gift that $10,000 of your S&P 500 fund, your ETF, to the church or to your donor advised fund, and that gets the giving done for that year. Once it's in the church's name or the donor advised fund, you sell it and you gift the cash to them because they don't want the investment. They need the cash to fund their operation. Okay? It's not taxable to you or to them when you sell it because they're a nonprofit. You get the tax deduction because you gifted that $10,000 worth of securities. But here's the problem. You don't want to get rid of your S&P 500 index. You still want to hold it. So you take the cash that you would have otherwise given to the church or to your donor advised fund, and you, at the exact same time you gift it, you contribute that $10,000 to your non-IRA account, and you buy the S&P 500. Now what's happened? You still own the same investment, but what's your cost basis? It's no longer $4,000. You donated that investment to the church and it was tax-free. Your cost basis for the same investment, the same number of shares, is now $10,000 because you just rebought it. You bought back into it. Again, complicated tax strategy, not for everyone, definitely demonstrates the power of comprehensive financial planning, looking at all 6 areas of your financial life. Any of those criteria fit in your situation, work with your certified financial planner to come up with creative tax planning strategies just like that one. If you don't have a CFP on your team, you can contact one of my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go on and take your next wise step in your financial life.